Hello, this is Justin Paolini from Building a Trader. Welcome to our 5th episode of Tales from the Trenches. Before we start, let me just go through the risk warning. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit, so before trading, please carefully consider the risks and the inherent costs and seek independent advice as required. Please contact us to discuss any questions or concerns you may have because we are here to help. And with that said and done, today we're going to talk about market sentiment. If you recall, in the last video, we talked about some of the differences between industry traders and retail traders. And one of the things we said is that industry traders have an in-depth knowledge of fundamental data and how it impacts market sentiment, whereas retail traders often believe that price discounts everything. So today we're going to understand exactly what is market sentiment and how it can be useful for creating trading ideas. So when thinking about market sentiment, always keep in mind these concepts. Crowd psychology, so how the market is currently positioned, where it's been going, and secondly, the tone of price action. Third, the attitude towards emerging fundamentals, and they can be fundamental factors, economic reports, seasonal factors, national and world events. So sentiment is a measure of the market's opinion regarding the probability of some theme's outcome. Okay, now this means that the market needs to form clear outcomes surrounding an event or another, and there must be an event on the horizon in the first place. So the first thing to take away from this is don't go looking too hard for drivers. Okay, there's either a theme or something on the market's mind that will be evident when you read some sources, or there's nothing there, and trading will be much more technical, perhaps more mean reverting. When there is a clear theme, when there's a clear direction, the markets will be sort of more directionally impacted, and there'll be a clear direction. Okay, so the two things sort of reinforce each other: the sentiment driver on the one side and price action on the other side. But don't go looking for these drivers. Don't go looking for sentiment. Don't force things because it's either evident or it's not there. Here's one example. Okay, in 2021, everybody has been latching on to the reflation dynamic. Okay, the reflation dynamic driven by a whole bunch of stimulus that central banks have been pumping into the markets, and that also governments have been pumping into the markets between Trump's stimulus checks initially, now Biden's even more expansive fiscal stimulus plans. But beyond that, the market has started to digest and sort of work in those stimulus plans into its future expectation for inflation. Okay, because the market is saying there's a ton of money being pumped into the system, so prices in the future should naturally rise because there should be more demand. There should be more money in the system available to purchase things, and so the market is discounting higher inflation going forward. The market is a discounting machine. When you think about sentiment and when you think about prices, think about the market as this giant discounting machine. It is always trying to factor in, to discount the developments that are happening around the world, and it's working that into prices. So that's why, in terms of reflation, you've seen the yield on especially US bonds, but generally speaking, bonds around the world, yields have been rising, and they've been rising steadily. I mean, we were below 1% on the US 10-year at the beginning of 2021, and now we're at, we've touched 1.7% before this last retracement. Now, knowing that dynamic, okay, knowing that the reflation trade is attractive and it drives up asset prices, and it attracts, the higher yields will attract flows into the US dollar, for example. you can use that to guide you towards higher probability trading opportunities instead of trading something that might not be moving. Okay, now when we think about the reflation trade, it's more than just knowing that people are talking about reflation. You need to know what to follow, what dynamics to follow on a day-to-day basis, on a week-to-week basis, to make sure that you are staying in touch with that dynamic. So, for example, more stimulus, whether it's fiscal stimulus or monetary stimulus, means higher inflation expectations. Less stimulus is, the exact opposite, lower inflation expectations. Now, more stimulus, more inflation, that means higher asset prices can be expected. So, stocks should have a nice bid tone. Real estate should be rising as well, and risk effects. So, the yen pairs, the Swiss pairs, they should be also rising in line with this theme. And what do we need to pay attention to? We need to pay attention to central banker speeches and views on inflation. So, as an example, even as recent as last week, we're at the beginning of April 2021. So, last week, Powell came out and continued his dovish remarks. Okay, so he's basically saying we want to let inflation run and overshoot. They're not worried about inflation. They also said they want to see consecutive monthly job growth. So they want to see a few months of non-farm payrolls beating expectations and the unemployment rate coming down. So you automatically know these guys are telling you what you need to focus on in order to understand what's going to change their view. Because remember that the big players in the foreign exchange market and the big influences come from central banks and governments. So listen to these guys when they speak because they usually tell you what to pay attention to. Government stimulus. Is Biden's infrastructure plan going to come to fruition, or are his tax plans, which are included in the package, going to scramble up the picture? We still have to find that out. That's still being debated. But Biden's plans, the $4 trillion package that already passed through U.S. Congress, that had already been discounted into 2021 and was one of the main reasons for the reflation trade. So following these dynamics, following more stimulus, less stimulus, and what will help keep the pressure on these policymakers. So more lockdowns or surging coronavirus infections will likely keep the lid on any taper talk or any ideas of reducing stimulus. Instead, reopenings, lower coronavirus trends, stronger economic growth, stronger PMIs, stronger data, that will all play in favor of that stronger growth and less need for stimulus. Okay, so all you need to do, you just need to know this at a fairly superficial level in order to understand the influences on currencies, stocks, bonds, etc. And this was one of the best trades of the year so far, the rise in dollar yen, and it was completely correlated to the rise in yields. Completely. Okay, all you needed to do was, trade in line with that theme. And that theme generates a certain amount of directional movement, right? Impulse and trend in the dollar yen. And all you do is you use your technical tools to get on board this strong trending instrument. And you've picked it out, not perchance, you've picked it out because you knew the dynamic in play. So you knew exactly what to target. This is how sentiment can help you. Of course, sentiment can help you form certain expectations around news events. Sentiment can help you get positioned, days ahead of news events. Sentiment can help you understand the outcomes of big events that you don't position ahead of, right? Like big political events, central bank decisions. By having an awareness of what the market consensus is, what sentiment is about a certain a certain dynamic, about a certain event, a certain theme, you will automatically understand what the reaction should be and be in an excellent position to benefit from that reaction. Okay, we almost always trade the reaction to these events. We don't trade immediately ahead of them, and rarely do we position way ahead of them, unless of course there's already a trend in place. There's already decent price action that is calling us in. So this is the advantage, like we were saying, if you know what the main drivers are on your preferred security, if you know the aggregate perception surrounding those drivers, if you can evidently see price honoring that perception, then it becomes possible to understand what will change the market's perception and what kind of scenarios would open up. So where can we go and find what's going on in the world, and where can we go and find these drivers and and read up on things? Well, you need to go to the source. Go to Reuters Currencies, Reuters Markets, a good economic calendar, and there are also some free bank sheets from some investment banks on the web. And all you need to do is you almost just need to read through the headlines of the main articles on the front page, because if something is important, then the Reuters analysts will have it on the front page. If if something is not that important, then you won't need to go looking for it. It won't be there. Economic calendar. You know what the market's expectations are for the news. You know what news is coming out, and you're just prepared for the trading week. And the bank sheets, they'll give you a very precise view of what people will be looking for in the coming week. And if nothing else, all of this work will help you avoid unforced errors. So what are unforced errors? Trading without knowing what's going on. So just following price action without having any idea of what's going on in the world, on your favorite pairs, on your favorite instruments, etc. Number two, trading without knowing what data is due. And this will bring about bad habits like trading in front of news, or trading in front of a central bank meeting. Trading in low volatility environments, trading when nothing is happening. It helps you avoid these unforced errors. Number three, trying to guess what a newsprint will be, right? Instead of waiting for the news to hit and evaluating the deviation from consensus. If the market is not surprised, the market won't move. If the market doesn't care about a certain event, it won't move. And then trying to analyze fundamentals and market data in depth. This is the opposite error. A lot of traders I've worked with seem to think they need to do their own work. They need to become investigators and analyze in depth, fundamentals and market data and correlations and intermarket analysis. No. We have many things to do during the day. You might be juggling a day job in your trading. You might be juggling a family, your day job in trading. We don't have the time, the resources, and often the experience to do a better job than the analysts. So I would encourage you just to take on board what you're reading and take it take it as the truth, and then connect market prices and trends and dynamics to that truth that you've read, and see if it makes sense. Okay, it's very superficial at one extreme, but on the retail side of things, less is more. Just like last time we said, less technical analysis, less clutter on your charts will help you trade better. Well, less in-depth analysis will help you focus on what really matters, because you just read it, you take it on board, you use it. End of story. Don't go in depth. It's not worth it. If something is evidently happening, it will be self-evident, and you will understand what its influences are. You'll understand what's driving it, just like the reflation theme that we just covered in this video. So again, whatever you do, just keep it simple and remain consistent. And of course, I'm always here to help you. If you want to come through coaching, I will give you my own routines for following sentiment, my own routines for structuring your trading week and your trading day, because sometimes you really do need to just use a recipe that works and that has been working for years. A final reminder, there are always opportunities awaiting for consistent traders. Just like my partners at FCI Markets, they're ready to fund you if you can show consistency for at least 3 months trading your account. We'll invite you for an interview. You can explain to us what you're doing, and we'll start the allocations. So this is the end game. This is what you should be aiming to do, not risking your own money, but risking other people's money once you can demonstrate a certain amount of consistency in your trading. I look forward to seeing you. I look forward to helping you out. Get in touch, email me if you need to. But otherwise, good luck for your trading week. This is Justin Paolini for Building a Trader. Over and out.